Caribbean countries need over 100 million US dollars to fund sustainable development, drive economic growth, and improve the lives of citizens. But regional development programs are constrained by a lack of access to resources as our countries grapple with high costs for essential services and severe vulnerability to environmental hazards and external shocks. At the Caribbean Development Bank, we know extraordinary problems need innovative solutions. Now, we will explore groundbreaking financing options to fuel growth and sustainability. We will discuss ways of unlocking capital and bringing global financial institutions together to provide more affordable financing for regional development. Utilizing international financial institutions' reserve resources for sustainable development. The dialogue starts now.
Good morning, good afternoon, and good evening, and welcome to this webinar for the Caribbean Development Bank annual meetings on a very important subject for the region and for the world: making money work for better, utilizing international financial institutions' reserve finances for sustainable development. To tackle this serious topic, particularly today when we live in a poly-crisis world, I'm joined by an excellent panel who are going to help us walk through and understand the issues that we are grappling with. We have first Dr. Jean Leon, President of the Caribbean Development Bank, who brings a distinguished career to this panel and has been leading innovative changes in the Caribbean Development Bank that we will hear more about. We also have Fede Alicia, who just joined the IFC as the Vice President for Finance and Risk, and we look forward to hearing from him. And then my sister Hassatu from the African Development Bank. She's Vice President for Finance there and also the Chief Financial Officer of the bank. And we have, last but not least, Mr. John Roll. He's the Governor of the Bank of the Bahamas. So with this panel, we'll hear first of all for a few opening statements from the panelists, and then I will go through a guided set of questions, and then I'm going to come to you in the audience for any questions that you may want to raise on this important topic. So to start us off, our host, Dr. Jean Leon, you're welcome to the floor to make your opening statement.
Thank you very much, Franny, and a great welcome to all of our listeners joining us. Let me probably start with a very stark statement by way of context. Finance doesn't do anything on its own. It has to have a purpose, and it has to be targeted in a way that can achieve goals that we set. And so from the perspective that we are interested in, what ultimately we are interested is to promote a resilient prosperity for all citizens of countries in the world. And that would be specifically for us today, the countries that are members of the Caribbean Development Bank. Now, once we anchor on that, then the real question is, why is it that we still have a problem of inadequate development? And I'd want to proffer that we have spent a lot of time focusing on making development equivalent symbolically with growth, economic growth, and creating tools and approaches on how we can improve growth, and by extension hoping we would get to development. But that does not actually occur, and it doesn't occur because growth and development are two very different things. And so what we believe at the bank, and we have been promoting, is that ultimately what is the link, the glue between development and any policies is resilience. Resilience broadly defined. And so we have indicated this in our strategic plan update that indicates that if we were to promote development, we could only do this through promoting resilience. Resilience in institutions, resilience in the social space, resilience in productive capacity, resilience in financing, and resilience equally in the environment. So that provides us with a very broad, holistic view on development that is anchored on the one thing that is critical to promoting development going forward. Now, as long as we can agree on that, then the question becomes what are the elements that we need? And so we have singled this down to the choice of investments. The prioritization of those investments should be guided by what we are calling the internal resilience capacity of countries. By extension, the financing needed to allow you to meet those investments need to also be anchored on internal resilience capacity of countries. And equally, even if you have the financing and quality choice of investments, you need implementation capacity. And therefore, we also need that to be guided by internal resilience capacity, whether it is pure generation and provision of capacity building efforts, or whether it is in the financing space to build implementation capacity. Those three elements need to be there. So today's discussion, while it is focused on finance and making finance better, I don't want us to lose sight of the fact that the choice of investment activities, the building of implementation capacity are two key elements that go with the finance to yield the optimal development outcomes that we are totally focused on. And so that's the setting. And what I hope we will be doing is looking at the broad set of financing elements and tools that can help us within this triangle process. And if we narrow it down even further to the environmental resilience element, looking at issues of climate change and how it fits that overall development space that we are talking about. So that's the background context, and we will go through, as Franny has indicated, various elements of that, but with a focus on the financing side. Thank you, Franny.
Thank you very much, Jean. I love the term that you've brought to the fore, which is resilient prosperity as an approach to use the tools that finance can bring to handle the climate risks that the region is facing. We look forward to hearing more from you in a little bit. I'd like now to invite Federico for his opening statement. Federico?
Good morning, good evening, good afternoon to everyone. It's a pleasure to be here speaking from Washington, D.C. As Franny mentioned, I recently joined the World Bank Group in the International Finance Corporation as Vice President of Risk and Finance. The private sector is the focus of my current role. And I come to this role from two previous multilateral group experience at regional level, the European Investment Bank and the Inter-American Development Bank. I'd like to bring to this forum the perspective of several institutional contexts where different solutions have been designed for common problems in development, and particularly bringing the angle of the importance of investment and private sector mobilization when it comes to development.
Sorry, we seem to have lost Federico, or am I the only one? Oh, okay. Thank you very much, Federico, for your opening remarks and for staying within time. You brought a very important aspect, which is the role of the private sector and the role of private finance, which I hope to hear more, particularly given your background having worked in multiple MDBs. I'm now going to turn to Hassatu. Hassatu, you've been at the African Development Bank for some time now in different roles, and you've been observing the challenges that the world and Africa is facing. Let's hear your opening statement.
Thank you very much, and good morning, good afternoon, everybody. And thank you very much for your questions, Franny. We recognize that there are immense need for the African in the African continent, for Latin America countries, and for all lower income countries of this world. There are significant investments that are required in order to address the challenges, the multiple challenges that we're facing. For example, for Africa, we're talking about the infrastructure gap. We're talking about access to basic services, surviving in a sense, but also multiple issues that have been just piling up. The most recent one being the climate, but also the COVID pandemic. So it is important. We have a formidable role to play. We have a formidable mandate. But it's very clear that it's not something that MDBs, I'm talking about multilateral development banks, MDBs, this is not something that we can achieve alone. So we need to be able to mobilize, to provide capacity to the public sector, to our government shareholders, but also to find a ways to mobilize the private sector, because that is where most of the resources are located. So the sustainable development goals, the SDGs, are not going to be met, at least for African countries. And that we need to find ways for multilateral development bank, which are really at the core of the international financial architecture, to be used to the fullest. And there are many ways of doing this. And I think that is going to be the topic of this conversation. Thank you.
Thank you very much, Hassatu, and thank you for sharing your perspective on what is challenging the world and challenging the institution that you are leading in Africa. Our last opening statement is going to come from John. John, you are governor of the Bank of Bahamas, a country that is not shy of managing risks in this turbulent climate change environment. Please share with us your statement.
Thank you very much, Fanny. I know we will speak later about the role that central banks can play regionally, but what I want to lend my voice to foremost is the importance of resourcing additionally institutions like the Caribbean Development Bank, so that we can better channel and use multilateral financing to address a lot of the resilience related challenges that we have ahead of us. And I think in the regional setting, what we really need to get across is that this is now the time to get beyond the difficulties that we often encounter as middle and higher income countries, given what I like to term the premium that is attached to the kinds of investments in infrastructure and the like that we need to see realized in order to build up our resilience. And we also have to appreciate the peculiarities of this group of small states, where even when the multilateral institutions are coming in to provide resources, the small scale on which projects are being executed often means that you need to come into a region like the Caribbean with some understanding as to how to execute those scales. And I think from that point of view, any opportunity that we can have to increase the resourcing and backing for the CDB particularly would be important. And that is whether we're looking at it from a concessional funding, such as low-cost special drawing rights, or to whatever extent grants can be brought to the table. But at a minimum, I think the principle that we should pay attention to is that we have to ensure that the Caribbean region gets access to expanded financing that helps to offset the higher cost that's associated with the resilience enhancements that I think we know that's so desperately needed. Thank you.
Thank you very much, John. Let me turn back to you with a few guided questions. And let me first ask you the work that we see the central banks playing right now in a polycrisis world has been really tremendous, but it has also tested the limits of what one can do with the multiple crises that we're facing. So, as a shareholder of the Caribbean Development Bank, and in your own capacity as governor of the Bank of the Bahamas, could you share with us some of the strategies that you see working in harmony between the central bank and the Caribbean Development Bank to bring solutions to bear in the current environment?
Well, the interventions might not all be CDB centric, but what I think is important is to recognize how central banking type interventions can improve the policies that go towards strengthening the environment for credit, because we do need uh, a lot of these interventions to be centered in the private sector, and we need to see more of the financing that's available in the private sector be channeled into resilience enhancing investments. And from that point of view, I think we need to see the environment around ease of access to credit, whether this is in terms of the credit bureaus that are uh, gradually being established throughout the region, and in some cases still need to be put in place, or the infrastructures that allow more parts of the private sector to provide collateralized loans, such as with the movable collateral registries. I think the Bahamas is working on that. But whatever we can do to increase more of the existing stock of financial resources in the region that is within the private sector, we can get more of those invested outside of the consumer sector. I think that's important, as well as how we can make it easier for the CDB to interact with our private sector from a financing point of view. I think that's going to be important. We also have to focus us on the efficiencies in our financial sector and the thrust around digital transformation and what that means for our banking sectors. Because I do think having more efficient banking sectors is also important for some of the incentivization that we need around how resources are being channeled and how lower cost resources are being channeled into the private sector.
And thank you very much for that. And if I may follow up then, when you look at what's happening in the region and particularly the tightness of access to credit for the private sector, what's your prognosis right now? Do you see any possibility of that improving in the coming months? Or do you see some of the solutions that you mentioned earlier that then rely on concessional finance and other such solutions to come to the aid of the private sector in the countries in which you are able to observe, including the Bahamas?
I think insofar as the private sector is concerned, if I use the Bahamas as an example, we have a very liquid banking sector. It's the credit risks that are presenting themselves that in the near term, I think, are impeding, the pace at which banks are providing new loans. So we have to continue to work so that over the medium term, we improve the environment around which lending institutions can manage credit risk. And again, the Bahamas being an example, we had a very early stage in terms of the credit bureau, but credit bureaus are not yet present in all of our financial systems. In addition, we're starting out in the region where, on average, credit delinquency rates much higher than the international averages, and therefore it imposes a cost in terms of how credit is being priced. As well, it's slowing down the level of enthusiasm that lending institutions have in terms of positioning themselves to lend in the near term. So we have to address reduction in the level of risk within the lending environment, and this is speaking just directly to the private sector liquid resources that are present. And aside from that, I think we have to find the effective interventions to get more of that private sector liquidity place in intermediary channels that start to look different than the banks, given the business models of the banking sector in the region on the whole. And it's something that we've been working on, and I know that the CDB also has put forward some ideas around how we can get a more invigorated environment for capital, private capital in the region. And I think if we can do that, we would see results, much better results, medium term.
Thank you very much, John, for that perspective, and it gives me a good opportunity now to turn over to Hassatu. Hassatu, you've been working over many years now in dealing with this kind of crisis that John has mentioned, particularly on managing liquidity crunches over different periods of time, including at the African Development Bank itself, managing risks, credit risk, but also risk concentration, and a lot of innovations that you have led at the bank. Could you share with us the type of innovation that you've been undertaking at the African Development Bank and the implication that it has for solutions in the polycrisis world we have?
Okay, so thank you very much for this question. So with the financial innovation or new mechanism depends on that you apply as an institution, depend also on the type of risk that you want to solve with. You talked about concentration, the governor talked about credit risk, liquidity risk, and so forth. So at the bank, given the mandate that we have and the limited resources that is at our disposal, we've been focusing on addressing the specific hurdles and challenges from a credit rating point of view in order to enhance our capacity. So balance sheet optimization is something that we have adopted quite early on, and it's part of our way of doing business. Risk transfer, specifically the use of guarantee instruments, first large structures to enhance and attract investors. So there are two parts of that. One is if you have a concentration issue, because the specific credit rating agencies puts a heavy, let's say, emphasis on that. What we've come up with is or what has helped is an exchange exposure agreement. The first one that was done in the world among MDBs with the World Bank and the Inter-American Development Bank. And I think that Federico was at the Inter-American Development Bank when it happened. So that has helped a lot, internally in terms of capacity. So we were able to create, let's say, at least the equivalent of $10 billion in internal capacity. There are also new structures that we have implemented with the private sector. The first synthetic securitization ever done by an MDB. Synthetic securitization is not a new instrument, but for the MDB world, it was a new instrument. And it's something that allowed us to attract the private sector, so private sector investors that have never taken African private risk coming into this transaction. And more recently, we did a transaction whereby we had government agency, the UK, FCDO, providing a $2 billion guarantee on our portfolio of sovereign countries. This combined with the 1.6 billion, this combined with the private sector for a total of 2 billion, allowing us to unlock private sector, additional resources for climate financing, and which has, enhanced, really capacity. So there is, as I said, financial innovation in order to solve for specific hurdles that you have internally or through credit rating agencies' metrics, but also attracting more resources into the continent, into the African continent, in order to help address the resources constraints. And when you want to attract the private sector, you need to have the right instruments, because there is that perception of risk which is higher in many cases than reality. But you need to have those, first loss guarantee or partial credit guarantees or in syndicated AB loans to accompany or to give the private sector, international investors, the confidence to come with you and co-finance or finance transactions onto the African continent. So these are some of the instruments that we are using internally in order to address this.
All right, thank you, Hastatu. Let me follow up on some of the remarks that you've made. In the just recently issued G20 report on capital adequacy frameworks for the multilateral development banks, there were a number of innovations that were highlighted, and I'd like to get your perspective on that and how you see it from the African Development Bank. For example, the unique use and innovative use of SDRs, the different ways in which one can conceive of hybrid capital or non-voting capital, and then any solutions related to callable capital. Would you care to comment on these and share with us any perspectives from the African Development Bank?
Yes, absolutely. And thank you very much for the question. So most of the innovations that were put on the G20 reports were innovations that had already been implemented or approved at the African Development Bank. I think that one of the most powerful is the idea of hybrid capital, because hybrid capital is, in my view, the second means after shareholder resources to that has the most impact. Hybrid capital can be structured in a way that it's considered as equity, and basically you can leverage it. So for the African Development Bank, it means that 1 billion of hybrid capital is $3 to $4 billion of additional resources that we can provide to our clients at affordable cost. So we have the board approved last year a sustainable hybrid capital instrument, and it's for us now to implement that. So you talked about callable capital. Callable capital is a very, very important tool for the African Development Bank. It's something that we use to the fullest. Basically, it is what helps us also get the AAA rating, so maximum use there. And we've made use of other instruments that have been quite impactful internally. But one of the one that I really like to talk about is the SDR rechanneling. So as you know, there's been the lower income countries of the world has received the lowest amount of resources, and the SDR rich countries, receive the most resources. Africa, for example, the 54 countries of Africa, for example, received an allocation that is lower than that of Germany, for example, and other countries. So we've collaborated with the Inter-American Development Bank, and we have developed a concrete solution in order to support the rechanneling of SDRs from advanced economies to developing countries through Multilateral Development Bank. So this, as you know, there is already the PRGT and the RST that are spearheaded by the IMF, which are very good channels for this. But our solution is complementary to those. So it makes use of the unique and powerful financial model, and this is the words of the G20 Capital Adequacy group that you led, Franny. So it's making use of the MDBs in a manner that is going to leverage the most resources. So just very, very quickly is that the SDR-rich countries lend SDRs to MDBs. They don't donate, they lend it to MDBs. MDBs who are prescribed holders of SDRs deposit those SDR with the IMF. They can earn the SDR interest rate. And the SDR interest rate is basically also the cost of the SDR to the SDR rich shareholders. So here you can have a very easy compensation and zero impact in terms of cost to shareholders, because basically we, the MDBs, are going to pay the SDR interest rate to the SDR rich countries, so zero cost to taxpayers. With that SDR loan, which we structure as hybrid capital, we can then go to capital markets and borrow against that new equity. So basically, $25 billion of SDRs allocated to or we channel through multilateral development banks is about $100 billion of additional lending capacity that those countries can have. And $100 billion is a number I hope that resonates with all, because this is one of the pledges and commitments that many developed countries made towards emerging market countries with regards to their contributions to climate, for example. So the solution works. It meets the reserve asset status. So what does it mean? It means that if a country that is an SDR-rich country decides to allocate the, let's say, $10 billion to MDBs, for example, they can still account for that as equity. As international reserve. So it doesn't take out of their the volume of reserve of international reserve that they have, while at the same time being used for impact in developing countries. So we believe that the SDR solution really is something that needs to be. It's a huge opportunity that needs to be seized. We've been very encouraged with the level of conversation we've had with some countries, notably the UK, and we do hope that other countries are going to join the bandwagon for MDBs rechanneling of SDRs.
Thank you very much. Thank you very much, Hassatu. You have really highlighted a number of areas which go towards how we use the reserve finances for sustainable development, particularly innovations around hybrid capital and the use of SDRs, but also how to sweat the balance sheet more with the examples you gave on risk transfer and the use of guarantees. So I'll now turn to Federico. Federico, you've worked in a number of multilateral development banks and have experience in working with supranationals in Europe and in Latin America. Could you share with us your perspectives, particularly on this question of how do we crowd in private sector finance to bear towards the challenges we are facing in development?
Thank you, Franny, and let me start by congratulating Hassatu and my former colleagues at the Inter-American Development Bank for developing what is really a joint venture between MDBs and their shareholders. And I wanna move off this start by using a bit of an image that could seem strange. In development finance, it takes three to tango. In my experience across different banks, and the three are the public sector, sovereigns in particular, the multilateral development banks and their peer group, and finally the private financial sector. And to explain where I come from when I make this statement, I'll go back to my experience with the European Investment Bank about a decade ago, when we were really just coming out of an acute sovereign crisis which had no precedents in post-war Europe, with countries suffering extremely high levels of unemployment, underinvestment, tensions to sovereign debt, which we thought Europe had left behind. The idea that came into policy circles and end up successfully implemented goes under the name of a Juncker plan. And it had three ingredients. The middle ingredient was to leverage the work of a European Investment Bank in fostering a rebirth of investment flows in Europe. But the European Investment Bank didn't have the risk capacity sufficient to get deeper into subordinated debt, into equity instruments, into the type of financial support that the European economy was calling for at the time. So it was decided that the EIB could benefit from shareholder guarantees in the form of a 26 billion first loss guarantee from the European Union to a portfolio of about 100 billion of higher risk loans to be generated by the European Investment Bank. Now, the power of a combination of having a first loss, and Hassatu spoke about the importance of first loss for mobilization. When the first loss is provided to a multilateral development bank, that allows the multilateral development bank to go deeper into risk than it could on its own. And this in turn attracts the private financial sector. In Europe, it was largely the banking sector, which is very developed. The governor of Bahamas has spoken about a banking sector being well developed in his country, and indeed in the Caribbean, there is a relatively well developed financial sector. In Europe, the financial sector, with the help of the EIB, was able to deploy a total amount of investment under the Juncker plan of 500 billion euros. So if you do the math, you take 26 billion of European Union guarantees, supporting about 100 million of European Investment Bank loans, supporting an additional 400 million of mobilization. And you get a very powerful multiplier effect by the collaboration of these three parties into the tango, which is the sovereign guarantee, the Multilateral Development Bank, and the financial sector. I believe there's no other example at this scale globally. However, many of the MDBs and many of the regions have elements of this scheme. We also increasingly hear the willingness of the private financial sector. You heard in Glasgow the Global Alliance for Net Zero. You increasingly hear in the United States interest in supporting sustainable development goals. Now, these calls from the financial sector come together with calls for multilateral development banks to take more risk. And this is only going to be possible with significant shareholder support. And these three ingredients together can deliver the multipliers. This is what I wanted to put as a perhaps not very well-known example in development, because it took place in an advanced economy, which is the European Union, but I still think very relevant for what we need to do going forward.
All right. Thank you, Federico, for sharing that example of the solution under the Juncker plan and the leveraging that was able to deliver. Maybe as a follow-up question to that, at the moment we have a huge demand for financing, and the role of the private sector is being seen as being catalytical and critical. How do you see the solution that was applied in Europe under the Juncker plan working in other regions, particularly to deal with climate risks and the other global public goods challenges that countries are facing? Do you see an opportunity there?
Was obviously the institutional setup of the European Union is very special because the European Investment Bank could receive its first loss guarantee from the European Union, which has a rating, and therefore effectively de-risks the first loss. We don't have the similar institutional structure for global or regional development banks. However, when I dug a little bit into that question, I just want to see how large is the budget of the European Union, and it's roughly 200 billion euros per year, and this compares almost coincidentally to the same order of magnitude to the budget for official development assistance. So we feel this is tracked by the OECD, and they issue regular reports on the total flows of official development assistance, ODA as they call it, and it is 200. Last year it was over $200 billion. So the question and the challenge that one asks is, can we find a way to leverage grants through MDBs at a bigger scale than already done? The MDBs receive trust funds, they receive and they collaborate with donors, and throughout the history, this has been done very effectively to bring development loans where otherwise the projects would not be sustainable without grants. Now that there is increased opening, particularly around the climate question, of the utilization of grants in middle-income countries, then I believe the analogy with the European Union becomes more powerful. The European Union was able to leverage effectively 26 billion of EU budget through a shareholder guarantee into 500 billion of investment. And depending on the areas, the multipliers is 10 to 15 times. So can we figure out a way to apply similar multipliers to at least some of the grants that are given annually as official development assistance? And this would be the challenge that together the public sector, the multilateral development banks, and the private sector are called to solve.
Fantastic. Thank you very much for illustrating how that can be relevant to other regions of the world. I'm now going to turn to Jean. Jean, you brought in this very important concept of resilient prosperity, and you have been leading the Caribbean Development Bank with a new strategy and a lot of innovations around how to bring in these finance sector solutions to bear on development. Please share with us more about the work that you're doing.
Thanks a lot, Franny. Let me first indicate that this has two parts to it, because the way we see this is we have, as it were, if I can use the analogy, a $1 trillion problem, and we cannot solve it with $1,000. And so the point that Governor Rowles started off with, that we need to find ways to increase the capital, the resources for the bank, is probably our starting point. We just do not have the ability to mobilize adequate and affordable finance for the task at hand. And so recognizing that, we have put together what we are calling the need for a multi-instrument, multi-sourced framework that is subject to adequate regulatory oversight and appropriate market infrastructure mechanisms. And it is only by combining this in that way we think we can actually get to the $1 trillion we need to solve our problem. Now, I'm using $1 trillion illustratively, not that we do need $1 trillion. But when you unpack this in terms of the sources, I think the sources for us have to come from potentially 4 options. The first option has to be to increase national savings. And there, I think the work that Governor Rowles was talking about in terms of the role of central banks, the role for governments in terms of using appropriate policies and stronger intermediation mechanisms in market and market development is one of the first things that's a plank of how do we begin to mobilize more as part of our own efforts. The second is we need to generate more native capital, and that native capital can potentially come from widening our membership, and so we have been pushing that envelope, or at least starting discussions to see how we can widen membership. The third is you have to be able to crowd in more private sector capital. And I think the various ideas we've heard both from Hasatu, and from Federico are things that we are actively looking at, because we need to consider the type of private sector financing institutions, syndication in the debt space. We need to look potentially at equity of private sector within the bank to grow that capital. And the third is to transform the bank into a kind of fund of funds approach, within which you can then optimize your balance sheet. And from that perspective, we are looking, I think, innovatively at the idea that we can solve the problems that we face, which is one of high vulnerability and low resilience, to generate stronger development by looking at options that, one, increase the amount of contingent debt that we can actually issue on our balance sheet, while at the same time increasing the coverage on the liability side through the issuance of hybrid capital, the perfect example of which Hasatu has actually spoken of, and do that in such a way that it does not compromise the credit rating of the institution or the financial soundness of the institution, so that our ability to borrow and do that very leveraging that Hasatu also mentioned becomes paramount. So that's, as you are probably aware, Franny, the context of the proposal that CDB in partnership with Lazard put through to the G20 MDB Challenge Group. And I think it is probably sufficient to say that we have actually been awarded, and with your permission, if I can say this, we have been awarded an award, a grant to actually develop this model to meet that particular line. And then the fourth area in terms of sources is, I think we need to simply find ways to utilize existing concessional resources better. And one of those, obviously, is the SDR rechanneling issue that Hasatu has spoken so eloquently on. At the moment, the CDB was recently, together with 4 other institutions, the European Investment Bank, the European Investment Bank for Reconstruction and Development, the CAF, Latin American Development Bank, and ourselves, and also the IDB, as 5 new prescribed holders of SDRs. And so that ability now to be able to rechannel some of the SDRs through the CDB for the benefit of our member countries becomes there. So we have at least those 4 areas in terms of sources. And when it comes now to the multi-instrument, it's clear to us that what we do need is to realize that there's no one instrument that can fit the totality of circumstances and purposes at any one point in time. So we need to have a suite of instruments that we can deploy in a fit-for-purpose way. So these are, as it were, innovative ideas, thought leadership ideas that we have been doing. But we have not rested there, because there are a number of operational issues that we have also looked to undertake to strengthen our work with the countries. And in the space of resilience, which is the foundation, as I indicated in my opening remark, we have sought to, especially in the climate space, embed that element of resilience and including vulnerability in all projects that we lend in that space. So, for example, we do a climate vulnerability impact assessment on all projects that we lend. We have equally sought to increase our ambition from moving from the 12 and 15% that we had as of late as 2017 to targeting 25 to 30% by 2024 of own resources to target climate finance. We have been providing technical assistance and almost concessional financing for various projects, especially in these key areas of climate that we are interested in and promoting in a very big way the green development in the region by looking to reduce greenhouse gases, and in particular taking a very active role in the renewable energy space in key areas or sectors in terms of transportation, in agriculture, in water, that can actually help us. And equally, from a developing space as well, assistance we are providing to MSMEs in terms of their adoption of clean technologies, building green competitiveness, and looking to make their entire operations just more sustainable to meet the resilience needed for the multiple shocks that keep hitting us. So both from the thought side, creating new strategies and thinking beyond where we are, and on the operational side, we've been looking to address that. And if I can just, on the last element we've actually done in terms of trying to get more from what we have, separate from the SDR rechanneling, we have been pushing and promoting the idea I introduced of internal resilience capacity of our countries. Now, what that effectively means is the challenge that we face as high middle income countries subject to high vulnerabilities and long duration periods for recovery after shocks. If we were to use internal resilience capacity as the means to target ODA thresholds, then in a sense, what we can literally indicate now is that many of our countries, if not all, would be much better off in being able to receive more overseas development assistance, because it would be channeled on the basis of resilience, which includes vulnerability, includes the deterioration that occurs after a shock, and includes the duration it takes you to return, recover to where you were before that shock occurs. So that entirety of resilience is really, in our mind, that which should be used for the provision of financing, concessional financing. So we would get more out of what already exists while we seek to build on the very issue of widening and increasing the development assistance envelope. So that is, I think, a set of things that we are working on now, and we've been advancing and pushing as much as we can, as quickly as we can over the last, say, 18 months.
Fantastic. Thank you very much for sharing the reforms and the innovations that you've been going through. As you were speaking, we got some questions from the audience, and I'll ask one of them to you. It's from Stefano Capodaghi on YouTube, and his question is on the SDRs. And he says, how do you unlock, that is, issue of reserve asset characteristics, the possibility of the EU countries to channel SDRs to the Caribbean Development Bank, such as what has been happening, or what the African Development Bank has been trying to do, and whether you can then use those as hybrid capital. So would you be able to comment on that question from Stefano?
I can in part, Franny. The European Central Bank had made a legal determination about the use and deployment of SDRs as the fiduciary agent of the governments of the EU, and whether they were in a position to use those SDRs in a lending way. It is not something which is specific to the CDB. I think it is likely to be something for all MDBs looking to rechannel SDRs. And for sure, the African Development Bank and the IDB have advanced more than we have, even if we are looking to do exactly replications of that which they have done. Hasidu may have a little more updates on this, but my understanding is that it is not a closed deal. There's continuing discussions on or searches on ways in which we can work around this. Whether we'll be successful or not, I cannot really say. But at the very least, I think the bigger issue is, one, can we get member countries of the IMF that have SDRs that they are not using or don't intend to or likely to need to use in the near future, to deploy some of those through, say, the issuance of hybrid capital. And I think there one would need to appeal to the entire international community that whereas, as it was also said, that SDRs in the IMF SDR department can be deployed. There is no leverage there. It is a one-for-one. On the other hand, if that were to be deployed through the MDBs, then you get the benefit of leverage. And so if we are focused on the development outcomes of interest, developing countries, then there has to be a case for public value. I would even argue a moral high ground to see benefit in channeling where you can get more for the dollar that you are willing to provide support for. The only issue for me would be, again, the points that Hasidu made. Do we have appropriate liquidity to preserve reserve asset status? And do we have high credit quality of that hybrid capital? And the work that has been done by both the African Development Bank and the IDB, and now I can equally indicate we have done for the case of the CDB, is the credit quality of the hybrid capital we would be issuing or we would like to issue based on the SDRs that will be rechanneled is of such quality that the probability of having to offload, as it were, or take on some of that risk is especially low, beyond multiple times AAA credit quality. And therefore, these member countries that have SDR should see no or have no difficulty from a credit quality perspective in being able to preserve their reserve asset status from any of the three MDBs that we are talking about. It's just an issue of liquidity and what mechanisms one would need to put in place. And again, Hasidu can speak to, there is a proposal on how the liquidity constraint can be managed in a way that, again, could give adequate comfort on reserve asset status of those SDRs to make it feasible. So I'd like to separate, as it were, there's a legal issue, and then there is equally an almost moral development issue that if you were to put those together, we can find a way, I believe, into opening the door, the avenues for the deployment or rechanneling of SDRs through the MDBs, as long as it is for the purpose of development.
All right, thank you very much, Jean. I'm going to turn to you, Hassatu, because Jean has mentioned that you would come in on this as well, given the degree of advancement you have made at the African Development Bank. There are two key issues. The first one, of course, is the leverage issue, when the SDRs can be utilized by the MDBs. And then the second one is the quality of those assets and the impact that it has then in ability to leverage. So could you comment on this question in general terms, but also specifically to those two issues?
Okay, thank you very much. So for the countries that are considering rechanneling SDRs to an MDB, one of the foremost conditions that they've put forward is that it needs to maintain the reserve asset status. And what they mean by that is that, one, on the credit side, it needs to be sufficiently secure. And then second, it's in terms of the liquidity of the proposal. So the way that we've developed that, it's a proposal that have two components. One is the hybrid capital, and the second component is the liquidity support agreement. And the combination of two is what ensures that the IMF can say for sure that these operations meet the reserve asset status, meaning that it's credit-wise it is secure. And if a country that provides the SDR to an MDB has a balance of payment issue, that country can access the liquidity support agreement. So that is the start of the discussion, and the solution that we have provided, in our view, meets the reserve asset status of the IMF. Now, once you've met that hurdle from the IMF, you need to meet the hurdles of some of these countries, because some countries are satisfied with the rules of the IMF, and others do require or have additional requirements in terms of reserve asset status. So we have very good discussions with the UK, with Japan, and with Saudi Arabia, and we're dealing with some of these technical issues and finding ways to address them in a meaningful manner. So we are on the right path with regards to these countries. It is true that the ECB, however, has a different view. So the ECB indicates that the countries, or euro-based countries at least, cannot allocate the SDR to a financial institution, and the ECB is only making an exception for the IMF. They're not making an exception for the MDBs. So that's where lies the problem. We've been concentrating on our discussions on non-ECB countries. With regards to the liquidity support agreement, it is a very important part of the solution, as I said, the hybrid capital and the liquidity support agreement. And we believe that countries that are not able to participate in the hybrid capital solution itself could come in via the liquidity support agreement. And this is a conversation that we're starting with European countries to see whether there is an appetite. So basically, it's a guarantee from a country that says that in the event that one of the participants in the scheme has a balance of payment event, and if the liquidity that has been set aside is not sufficient, they would be willing to step in. Understanding that the way that we structured the solution, we are taking as potential provider of SDRs the countries that are remote from a balance of payment issue. So our discussion when we're discussing with the IMF, we ask for the criteria, and there is what they call the IMF transaction plan, which indicates which provides the list of countries that are remote from a balance of payment event. So just to make sure that all the boxes are ticked and we have something that is very secured. So this is what I want to add. The solution that we provided is a solution not just for the African Development Bank or the Inter-American Development Bank. It was developed for all the MDBs that have a setup that is similar to ours.
So thank you. Thank you, Hassatu, for clarifying the two important elements. One of the hybrid capital and how SDRs could be used for that, but also the liquidity support agreement that may be an opening for those countries that are restricted through the ECB legal ruling. I have a question from the audience for Federico, and the question is coming on also on YouTube, and it says, on the private sector matter, could other guarantee solutions, for example, the EU or the World Bank Group, be used for private sector development as EIB example that you have mentioned, Federico?
Let me first, there were questions. I was also looking on YouTube. What is the EU plan I was referring to? You will find it if you Google European Fund for Strategic Investments, or EFSI. That is the legal name that was used in the European Union. But it was also It's also known after the name of Jean-Claude Juncker, who was the president of the European Commission at the time, a Luxembourger. And so it goes under the name of Juncker Plan or European Fund for Strategic Investments. The way to connect these two elements is through shareholder guarantees, essentially. And will the highly rated shareholders of Multilateral Development Bank can individually or on a joint basis issue first loss guarantees, which will in turn, naturally, when governments issue guarantee, there needs to be a backing for the guarantees in terms of government budget. Just like when the European Union issued the guarantees to the EIB, it used the EU budget as a backing for those guarantees. So the idea to explore would be shareholder guarantees that are in turn supported by official development assistance. And this will allow the leverage of grants that I was mentioning. There are shareholders that individually are large enough to issue meaningful guarantees. Just to give you an example, working with the Swedish International Development Agency at the Inter-American Development Bank, we were able to receive an individual guarantees. Sweden is rated AAA. And so essentially the guarantee issued by a country of that creditworthiness no longer uses up capital of a multilateral development banks. So there are countries that are either very highly rated or potentially very large that can issue shareholder guarantees, or pool of countries can agree on a joint basis to guarantee specific portfolios of MDBs, particularly for sustainable goals that are shared and considered of primary importance.
All right, thank you, Federico. I see there's a lot of interest and excitement around the guarantee instrument, so it's good that you have all covered it. Unfortunately, we have run out of time, so I'm going to be going to each of you for your closing statements, and you each have 3 minutes. So, Governor John, I'm going to give you 4 minutes because I would like you also to address some of the comments that have been made by the other panelists on the role of central banks in general, so that if you would comment on that in addition to your closing statement.
Well, thank you. I think the most important point that I want to reiterate is that we should ensure that in these arrangements we give due consideration to the premium cost that is attached to the resilience building that's needed, particularly within the Caribbean region, and that be offset against the rash considerations that often come up around middle and high income countries. So from that point of view, I think it is very important for us to ensure that the Caribbean region has access to the resources and some of the frameworks that are being developed by the African Development Bank and other agencies. So I like the work. I believe that it also provides a way to leverage how we can draw more of the regional financial assets that are already sitting in highly liquid forms. And even if it means perhaps the CDB is able to tap into some of that with the hybrid capital and other types of instruments that we can come up with. And from that point of view, the role of the central banks, I think, is really to continue to improve the the quality and the health of the credit markets, and also to see how we can enlarge the size of the market insofar as the private sector can perhaps achieve even greater scales in terms of some of the interventions that we would like to see in the private sector. And what I'm getting at is that we want to see the MDBs, and particularly within the Caribbean, to see them touching and impacting the private sector a lot more in terms of the climate and other related interventions that we might undertake. Thank you very much.
Thank you very much, John. I think you brought really centrally the question of middle-income countries and the challenges that they face as we look into this poly-crisis environment that we are all in, and then the critical role that the central banks play, not only for macro-fiscal stability, but also for the role played in strengthening the credit markets so that the private
Oh, it's not us. Okay, good. Sure. We are on. Sure. Now we'll stay. Sure. Sure. Yeah. Very good. Thank you. So maybe I want to make a couple of remarks while we reconnect with Franny. The first, I think, is the point that Governor Rule has just made. I think it is fundamental that we have to reconnect development and development outcomes with a almost new concept, the concept of internal resilience capacity, because that is the only way we bridge the high middle income status of our countries with the high vulnerability that we have, with the high debt that we have, and the resilience required to be able to generate development outcomes. And that is one area of advocacy that I think is essential going forward. And that, as I indicated, could also be the linchpin on how finance could be apportioned in terms of access and affordability. The second point, I think, is equally clear. We have to reimagine the relationship with the private sector. The private sector, as we understand it in what we call PPPs, can be much, much more enhanced if we see it as a partnership with the private sector, because it takes a whole society approach to development, meaning the governments have to do their part, the private sector have to do their part, the external environment has to do its part, but these have to be structured in a partnership that puts first and foremost development outcomes as the center of what we are looking to engineer and to see how you get there. And so it's an entirety of relationships that need to be complementary, that need to be harmonized, and not one of mutual distrust as exists now between the public and the private sectors, and the focus being more national objectives, development goals that become paramount in the decision-making process. And then the third, obviously, is we have to mobilize and mobilize aggressively in all of the areas that I pointed out in terms of sources that will give us adequate finance to allow us to generate the projects, the investments that are needed to meet those development outcomes, while ensuring that we stay laser focused on implementation capacity, because that is one of the almost Achilles heels of the region. We don't have enough capacity, or we don't demonstrate we have enough capacity to be able to deliver on all of the goals that we would like. So that would be the summary I would have. I think, Franny, you are back if you'd like to continue.
Yes, thank you very much, Jean. We have terrific internet and power challenges here, so I got temporarily blipped off. So I don't know, Hassatu, whether you were able to make your remarks in the interim, but if not, please go next.
Okay, thank you very much. And what I would like to say is that there is a stark need for additional resources. And in the words of President Dr. Jean Leon, you cannot apply thousands to $1 trillion problem. The G20 has been calling on MDBs to be innovative and increase their lending capacity through financial innovation. And the call has been heard because all the MDBs have been struggling and looking at different ways, cooperating to increase their lending capacity. What I'm asking now is for the G20 countries to help us be innovative. Federico indicated that it takes three to tango. In the case of the SDR rechanneling, we have the IMF, we have the MDBs, and we have the shareholders. Solutions that we have, meets the IMF status criteria, reserve asset status criteria. We need now for the idle reserves that are kept in the SDR-rich country to be put to work for the greater good. And that is going to be done at zero cost to these countries. We are not asking for grants. We are asking for a subordinated loan. There are trillions of dollars available in the international reserves of these countries. What we're just asking is a very tiny amount. $25 billion to all MDBs, for example, means $100 billion to the developing world at zero cost. So this is my call actually to the G20. We are being innovative, but we need you to help us become innovative. You have MDBs that have a unique financing model that can provide $100 billion to the developing world almost instantly. So please use the MDBs. Thanks.
Thank you, Hassatu. Federico, your closing statement.
A lot has been said by the other speakers. So I just want to go back to first principles and just submit the idea that all growth and resilience ultimately boils down to investment by the private sector. If you think about it, even when a government builds a road, they contract it out to the private sector, and that private sector contractor has to find finance. So if we can enable the real sector in our economies to invest for growth and for resilience, as we have discussed, we will move towards the Sustainable Development Goals that, again, are achieved in the real sector. Now, what the trio of governments, multilateral development banks, and private financial sector can do is mobilize and make available the sources of finance, public and private, that the real sector needs in order to deploy. So I would very much follow in President Leon's remarks. I would invite not to think too much of a challenge as public versus private, but as real versus financial, and not as an opposition of real and financial, but how the global financial sector, which comprises several operators, as Hassatu reminded us, can deploy resources towards the real sector.
Thank you very much, Federico. It's now to me to bring this session to a close, and let me highlight three important things that I heard from our really distinguished panelists. First, the MDBs are unique institutions, and if we didn't have them, we'd have to create them, and they stand at a historic moment now to provide a solution for the challenges that the world is facing. However, for those MDBs to prepare and deliver those solutions, they do need to look first of all at themselves and the way in which they define risk and the way in which they use the balance sheets to the maximum. But they also require support from their shareholders, and the shareholders can come forward with solutions both in terms of innovations in the use of SDRs and other forms of support like guarantees. And finally, the MDBs could be great partners to work together with the private sector to bring in the kind of financing that we need. And within all of this, there is a central role played by the central banks, who are the custodians of macrofiscal stability and the needed support for easing the credit crunch that the private sector is facing. So please join me in thanking this incredible panel: President Jean Leon, President of the Caribbean Development Bank, Vice President and Chief Financial Officer of the AFDB, Hassatun Sele, Vice President of the IFC Risk and Finance, Federico Galizia, and Governor of the Central Bank of the Bahamas, John Roll. Fantastic panel. Thank you very much for your views today and for sharing your perspectives. I now hand over to the end of this session, and thank you very much for inviting us, and I wish you a wonderful annual meeting, President Jean Leon and colleagues.